Good afternoon, ladies and gentlemen. My name is Larry Lederman, and I'm the coordinator of the CIGI's Global Policy Forum here in Ottawa. I'm delighted to see friends from the Diplomatic Corps, especially the Ambassador of Mexico, who is here, His Excellency Francisco Suarez Davila. And we also have members of the embassies of Romania, Slovakia, Italy, Germany, Spain, India, Japan, and Indonesia, and representatives of Parliament, the Department of Foreign Affairs, Trade and Development, the National Defence, Heritage Canada, Finance Canada, the Bank of Canada, and the University of Ottawa and Carleton University. It is now my pleasure to ask Scott Clark, a member of the operating board of CIGI, to introduce our speaker.
First of all, it's a pleasure for me to welcome everyone here this afternoon to CIGI's second forum in 2014. And these forums have shown over the past that they're an excellent opportunity to discuss policy perspectives through the eyes of international recognized experts. It is clear that the policy impacts of recent global financial crises will be with us for quite a time, especially as we further our understanding of the interconnectedness of the global economy and its ability to withstand crises. And few people could bring the same level of historical perspective and scholarly depth to these issues as Harold James, our speaker this afternoon. Harold is a CIGI Senior Fellow and a Professor of History and a Professor of International Affairs and a Professor of European Studies at Princeton University, where he's also the Director of the Center for European Politics and Society. So he's obviously a very busy fellow. He's a specialist on German economic history and globalization, and Harold is the author of a number of books, and I think the most recent is The Making of the European Monetary Union, which was published in 2012 by the Harvard University Press. He is a co-author of a history of the Deutsche Bank, which won the Financial Times Global Business Book Award in 1996. He has been awarded a number of other awards. In 2004, Harold was awarded the Helmut Schmidt Prize for Economic History, and in 2005, the Ludwig Erhard Prize for writing about economics. His current work is concerned with the history of European Monetary Union, and in the fall of 2013, CIGI published Harold's study of international cooperation and central banks as the inaugural volume in CIGI's Essays on International Finance series. And it is this work that forms the basis for this afternoon's presentation and discussion. So ladies and gentlemen, please join me in welcoming Harold James.
Good afternoon. It's a tremendous pleasure to be here, a great honor to speak about this little essay that was published at the end of last year on international cooperation in central banks in the CIGI series essays on international finance. I wanted in the essay, I think there are copies out there, I wanted to really play with a paradox or a problem, because it seemed to me that in the aftermath of a global financial crisis, whose origins lay clearly in global imbalances and whose transmission mechanisms were very much cross-national, there was prima facie an enormous demand for more substantial and more institutionalized cooperation. But in fact, we haven't really seen that, and we've seen more and more tensions between central banks in terms of their ability to cooperate internationally, and more tensions in the international framework in general. I would suggest, and that's really the bottom line of both my remarks this evening and of the study, that the real problem is that the crisis has produced a change of emphasis. We used to think that the primary responsibility of central banks was monetary stability, a certain level of inflation, low level of inflation. But after the financial crisis, it's become really obvious that at least one of the major tasks of a central bank is the stability of the financial system. And it's that focus on the stability of the financial system that's led central banks to become more nationally focused and, in consequence, less prone and less willing to cooperate. Because if you think of the definition of cooperation, it's a hard topic to define very, very precisely, and there's a narrow line between coordination and cooperation. But both cooperation and coordination seem to me, at least, to imply some circumstances in which a central bank, or for that matter, when governments talk about cooperation, the same story, when they do something that is not in the immediately perceived short-term interest of their particular constituency, for the sake of a greater good, which will have long-term benefits for their constituency, but whose short-term benefits may not be obviously apparent. What's happened since 2008, since the Lehman crisis, in this now 5.5-year period, has really been a general weakening of cooperative processes in general. Two examples that are really not to do with the narrowly defined issue of central bank cooperation. The story of the G20. In the aftermath of the crisis, this was the immediately effective and stunningly, brilliantly coordinated response to the financial crisis. It reached a kind of high point in the G20 summit in London in April 2009, and the then Prime Minister Gordon Brown was boasting about how he'd been able to save the world. And I think a lot of that is actually not exaggeration, but correct, because there really was a threat in the spring of 2009 of a contagious crisis that would have emanated from collapsing economies in Central Europe. The most dangerous one at that time looked as if it was Hungary, and that it required big, effective, coordinated action to increase the resources of the IMF, get IMF programs for the East European countries that were threatened by the collapse then. And it actually effectively stopped the contagion. But even that episode really cast some kind of doubt then about whether the coordination really was such a good idea in the immediate interests of the countries that were doing this. Because one of the points that Gordon Brown, for instance, very much emphasized in the London summit was that the major industrial countries needed a coordinated fiscal response to the financial crisis, that you needed fiscal stimulus, coordinated fiscal stimulus. Some countries did that very effectively. The United States did that, China did that. Some countries did that by the automatic contracyclical mechanisms built into their fiscal system. But other countries did that with really a rather bad effect. So advising Spain to do more fiscal stimulus in 2009 looked by 2010 already to be a rather foolish and reckless piece of advice. And the subsequent story has really been a withdrawing from this this intense period of cooperation and a relationship that's marked by some really high-level policy disputes, as in the dispute in the Seoul G20 meeting between China and the United States. The IMF also looks more vulnerable in the aftermath of the financial crisis for peculiar reasons, and we could really spend quite a long time thinking about the particular problems of the IMF, but it's over-engaged in Europe and split in a really dramatic way. A few months ago, the details of the discussion in the IMF board for the first Greek rescue package, May the 9th, 2010, were revealed. And it was clear there that in that debate, the board was absolutely split, and only the EU members and the United States were in favor of the Greek package, and everybody else, above all the emerging markets, but even Switzerland, delivered grim warnings that this was a reckless endeavor in which the IMF was likely to face substantial problems. And emerging markets looked at this engagement in Europe and began to wonder, is it right that poorer countries should really be devoting resources to the rescue of a very rich area that's got, by a peculiar process, into difficulties? I wanted to illuminate the particular issue of the central bank cooperation by thinking a little bit about history, and I want to focus very, very briefly on two historical episodes. First of all, the great era of central bank cooperation, which in many ways has some kinds of analogies to the world up to 2008, was in the 1920s, in the aftermath of the First World War, with the restoration of the gold standard and a very, very pronounced doctrine that central banks should really cooperate intensely and closely. And you will find some of that discussed in the essay outside. I mean, it's really stunning how close the central bank governors were to each other, how homogeneous, how uniform their worldview was. I quote, for instance, the most influential figure in the American central bank at that time, the governor of the Federal Reserve Bank of New York, Benjamin Strong, writing to his colleague, the governor of the Bank of England, Montague Norman, saying, "You're a dear, queer old duck, and I need to lecture you from time to time." Well, that's a kind of language that I don't think central bank governors really use in the. They were very, very close in the 1920s. What made them close, and I think that's the serious bit of the analysis, what made them close is that they were bound together by a particular rule. The rule before the First World War and in the 1920s was the rule of the gold standard. The rule from the 1990s into the 2000s was the rule of monetary stability and particularly of inflation targeting. When that rule begins to erode, there was a revulsion domestically against the intense central bank cooperation. And in one country after another in the 1930s, central banks were nationalized, put under political control, and their leaders controlled in such a way that they couldn't possibly engage in such an exercise of international cooperation, which was then read in retrospect as being cooperation that was directed to some kind of international goal, but not directed towards the good of the domestic economy and the domestic constituency of those countries. So, is there an analogy to that in the recent period? There is, I think, and it's also stunning to read the recently released transcripts of the Federal Open Market Committee meetings in the immediate aftermath of the Lehman collapse, the meetings of September the 16th and October the 28th, 2008. Because that makes very clear the extent to which the central banking universe has shifted. Who is the effective lender of last resort in the international monetary system in injecting liquidity? Who coordinates the really quite unprecedented, coordinated, synchronized round of interest rate reductions in October 2008. It's really the Federal Reserve System that's acting as the world's lender of last resort. And what astonished me when I read these transcripts was how internally controversial it was. Because the immediate story is that the aftermath of Lehman exposes a funding problem, an enormous funding problem, in particular for the major European banks, that they're unbalanced internally and depend on dollar funding. The ECB can provide liquidity, but it can't provide dollar funding. And so the United States, through the swap network, turns itself into the international lender of last resort. So it's really the Federal Reserve System, rather than the International Monetary Fund, that stands there as the lender of last resort. This works well. I don't want to criticize this. It's an astonishing success, and it's actually what stops the 2008-2009 experience from being a repeat of the Great Depression. Because there was one moment, for the 6 months between September 2008 and this April G20 meeting in 2009, for that 6-month period, we really saw trade falling at a faster rate than in the Great Depression. So this was a big success, the provision of liquidity. But as you go on into this discussion, the terms of the debate really change. And people are wondering whether it isn't, in the case of a substantial number of banks, a solvency problem that shouldn't be addressed by simple liquidity measures, whether it isn't a solvency problem, and whether, in consequence, it really isn't a fundamentally fiscal issue rather than a monetary issue, because the monetary role, the traditional monetary role, is to provide liquidity, emergency lending, the kind of set of doctrines that go back to Walter Bagehot in the 19th century. And the aftermath of the crisis demands making choices about the support of institutions, banks, but sometimes other companies as well, that are not clearly just illiquid, but may potentially be insolvent. The problem about operating in the crisis is that you don't know. It's the famous problem of how to react in the moment of the crisis. It's hard to tell the difference, and there's a powerful case to be made that effective action on the liquidity front can prevent insolvencies and can push the economy back into a better equilibrium rather than letting it fall into the suboptimal equilibrium that panic market reactions will create in a panic setting. So this was the first stage. Then the second stage, you start to think about bank restructuring, bank insolvencies, rescue funds for banks in the European case, and banking becomes much more nationalized, much more watertight in segmented national compartments. The ECB is deeply worried about this phenomenon of the parcelization or the renationalization of European banking and financial intermediation. And policymakers everywhere start to look at banks fundamentally in a national context, because the expense of their rescue has to be borne by the taxpayers of that particular country. They can't be redistributed internationally. If that's the case, you really need to think of it in a national context. And the most difficult banks to deal with were those cross-national banks like Fortis or Dexia in the European context. There's another way in which the discussion of the liquidity measures has prompted a new kind of national thinking. And that's really just the effect of the unprecedented injection of liquidity and the way that that spills over onto external markets. And in particular, it fueled an emerging market boom as capital was easy to raise and flowed into the emerging markets. And many emerging markets at the time worried about this effect and worried obviously into anticipation also of the kind of reaction that there would be when the liquidity was curtailed. So when the tapering debate started last year, you saw this initial panic in some vulnerable emerging markets. And the response of the United States to this, and the response of American policymakers to this, was, I thought, very interesting and very telling. It was that the national authorities in the emerging markets really had the responsibility themselves of counteracting the bad effects of the policy in the US or in Europe, of the high liquidity provision, and that they, in the emerging markets that were subjected to these capital inflows, should apply some measure of delicate capital controls in order to stem the inflows, make it more expensive to carry out these inflows. And in effect, a plea for more capital market regulation in order to stop the unwanted and maybe unanticipated effects of the big liquidity provision in the industrial economies. So the policy aftermath is that in financial supervision, if you think of the provisions in the Dodd-Frank measures in sections 165, 166 on the capital buffers that are required for the American subsidiaries of foreign banks, in banking regulation in Europe, more nationalism, more of an emphasis on capital controls in order to stop the effects of central bank liquidity policy in one area from spilling over into other areas. But I also thought there may be something else, something even bigger than this taking place, and that's where I wanted to think about my second historical precedent for one way in which the world might develop in the next 5 or 10 years. And the precedent there is not the Great Depression precedent, in which the world did become more renationalized, finance was more segmented. But the precedent there is a crisis that's much less well known, but actually very, very interesting one. In the United States, almost 100 years before the failure of Lehman Brothers, the crisis of panic of 1907, so 101 years before Lehman. And it was that panic that prompted the calling of the National Monetary Commission, the debates that led to the creation of the Federal Reserve System. So the idea of creating a central bank was the result of a big American panic. And the rationale behind it was spelled out in the following terms, that 1907 was a contagious panic in which many countries were affected. The one country that wasn't affected, paradoxically, was the center of the world financial system, the UK. London acted as a kind of transmission mechanism for gold flows from France, from Germany, from India, from Egypt to the United States. but the Bank of England dealt with the crisis brilliantly, and the London market was hardly affected. And the periodical The Economist had endless self-congratulatory articles about how immune the British system had been. And the United States, the debate turned very much on that issue and on that outcome and said, we really need something like the Bank of England in the United States. That was the motivation that produced the Federal Reserve, operating with its own acceptance market, developing an acceptance market, developing New York as a great financial center. And it seems to me that in retrospect, when people think of the long-term outcome of what we've seen after 2008, they will also say, as people did in 1907, that this was a crisis, in this case clearly originated in the United States, but actually did less damage in the United States than it did in Europe, or that it may do in the next years, in the immediate future, in emerging markets. So what big emerging markets need to do is to develop themselves as big financial centers. And in particular, the PRC has taken this lesson, this message of the 2008 crisis on board. So the PRC is, as it were, the United States of the 21st century, building a system that will provide deeper markets and more effective financial capacity so that there's less vulnerability to the side effects of what goes on in the United States. But let me just add one note to this, which might not have been as interesting even a few weeks ago as I think it is now, because there was a lot of security thinking that went into this story after 1907. There was security thinking in the United States, there was security thinking in the continental European countries, particularly in Germany, that Britain got an unfair advantage from its financial preeminence, and that countries like Germany or the United States needed to build up their capacity to act in their own interests in the case of geopolitical conflicts. And that may be the world that we see more of in the foreseeable future. There's an intensification of geopolitical tensions, whether it's in the Middle East or in the South China Sea, or now in Ukraine. And the optimism that the British had in the aftermath of 1907, 1908 was that their financial center, their control of the financial center, allowed them really a power tool that wasn't dependent on conventional military force. They didn't necessarily want big naval battles, but they knew that they could control the financial instruments to cut off the Central Powers in Europe in the case of a major escalation of tensions. Britain tried to do that with the outbreak of war, but it rapidly proved counterproductive. And Britain discovered after 1914 that using financial sanctions did much more damage to the British economy and to neutral economies, above all to the US economy, than it did to the Central Powers, to Germany and Austria. So looking at that historical parallel, it's an uncomfortable one. It makes me certainly very nervous, but looking at it makes me wonder if we haven't got an exaggerated estimation in the United States, maybe in other countries as well, of the effectiveness of financial sanctions in great power tensions, in great power conflicts, and that we don't fully appreciate the risks that are inherent in that kind of strategy. So when you think about the possible escalation of a crisis over Ukraine and tensions over Russia, I think it's not unrealistic to think that the fallout from a crisis like that would be intense in Russia, and it's already been seen in Russia that that's had an effect on Russian policymakers this Monday. But it's longer-term impact might be more acute in the financial centers that try to impose those sanctions. That's a lesson of history from the aftermath of these two crises of 1907 and the Great Depression, where financing central bank activities become much more embedded in national power interests, and cooperation is much more difficult. As you can see, I think this is fundamentally an unsympathetic and dangerous world, but it's one that we need to think of the instruments that we should use in order to navigate that uncertainty and those dangers. Thank you.
I'll ask a fairly easy one, just because I'm the one that is taking the first position. You alluded to the fact that China will, as part of their sort of learning from the various recent history, particularly 2008, 2009, that they are seized with building up their own capacity so that they no longer are as vulnerable to a US-led crisis. At the same time, we're all increasingly aware of how rapidly their shadow banking system has developed. And to my knowledge, there isn't truly an understanding that is demonstrated yet at their policy level of the depth of danger that that would pose to their objective if it is to become more self-reliant.
Yes. Yeah, no, absolutely. It's a very good point. They're obviously wrestling, like other emerging markets, with tremendous problems of property bubbles, other kind of bubbles, and financial sector bubbles, I think the awareness of that, the awareness of problems in the bond markets, bond defaults, that all pushes actually in the direction of saying you need greater control, but you need that in a national context. So if the shadow banking system goes wrong, it needs to be regulated, but the costs need to be absorbed, and the mechanisms need to be developed in a particular national context. Now, this is also where I think the 1907 parallel in the US is actually quite an interesting one for the development of China, because the US had a very vulnerable banking system after the Civil War, after the National Banking Act. But in the 1900s, in the first decade of the 20th century, there was a kind of shadow banking system that emerged with the so-called trust companies. They were not banks, but they developed very, very rapidly as part of a big equity bubble as well. So in some ways, it's very parallel to the Chinese story. And then you say, yes, we need the Federal Reserve System, that the Federal Reserve System is going to be able, in the event of financial sector collapses, to provide emergency money that doesn't depend on importing gold from Europe, because that was the bottleneck that had produced the collapses in 1907. And so, I mean, in some ways, the equivalences are almost too neat to be true, that the dollar in the international economy is the equivalent of gold. The Chinese obviously can't make dollars any more than the Europeans can make dollars. So do they get access to the swap lines? No, they don't. I mean, this was also part, actually, of this fascinating discussion in October 2008, because there were swap lines that were then developed for 4 emerging market economies, for Mexico, for Brazil, for Singapore, and Korea. And the report of this transcript says that there were other countries that had asked for similar lines. Their names have been redacted out, but I think people can guess who they are. who had applied and who weren't considered to be part of this. And so, this is very much still the lesson of that story.
Thank you, Professor James. It's wonderful to have history brought to bear on economic policy matters. The only problem is there's only one country in the world that really rejects history normally when they say, "Oh, that's history." It happens to be the United States, which is an interesting perspective. I wanted to bring up or tie together your previous comment in a different sense. You've made the point that the Federal Reserve has become, in fact, the lender of last resort. On the other hand, so that's a cost, I think is the way you would phrase it. On the other hand, the United States dollar is the world's reserve currency, leaving the United States with an extraordinary privilege because it's the only country, of course, that can borrow if and when for whatever balance of payments problems it might have. They're the ones who can finance it compared to the rest of us who have to get involved in other arrangements. If I can ask you as an economist, if you have to balance the costs and the benefit to the United States in general, which way would you come down?
It's really an excellent question, but it sort of boundaries on economics and politics as well, because what struck me about this discussion in the Open Market Committee in 2008 was how selective it is, and how they say, yes, there's something special about Mexico and Singapore and Korea, and then one of the speakers, one of the Federal Reserve Board presidents, says, but Brazil is dodgier than the others. So there's a kind of gradation that's going on, whether it's politics or whether it's economics. It's a very odd sort of business that is taking place there. The United States, I think it does get a benefit from being able to borrow in its own currency, but actually other industrial countries can do that as well. The point is that they can probably do it less than the United States can, but certainly the UK can, certainly Japan can. The Europeans, if they got together, could do this, and it's one of the incentives, it seems to me, to develop if you're thinking of the optimistic developments in the future, develop a common European security market for government debt, a common European bond, would be quite a good idea. And probably in the longer run is a necessary feature of this rebalancing of the world economy. I think the cost side of the so-called exorbitant privilege is actually, it's not just a feature of the US economy, but it's a feature of any economy that's a big financial intermediary. So it's still a feature of the UK economy. And I thought that was an interesting part of this week's discussions, that the UK government clearly recognizes how vulnerable it is to applying financial sanctions to Russia. So that for me is as great a vulnerability, this exposure of a big financial system to a world in which many of the liabilities are held by either individuals or corporations or shadow corporations in other countries and in emerging markets.
Tony Zoba with the Canadian Life and Health Insurance Association. I guess back in October, I think it was, 6 central banks got together and decided to make their currency swap agreements permanent. I'm wondering how exceptional you think that kind of coordination is between those banks, and whether there's anything exceptional about those particular central banks versus some other ones. And just taking into consideration what you said about the emerging markets debate recently in the U.S. and their decision to, or their statements regarding coordination with them.
Right. No, I mean that's an excellent question. I mean, logically, the outcome of this new role of the Federal Reserve as the international lender of last resort would be indeed to make long-term swap arrangements with many countries and to develop a big international swap network. But you could see, even in the crisis situation, even in 2008, how controversial this was and how people, even on the FOMC, were wondering about whether there really wasn't a balance sheet risk to some of these activities. And most of us don't think that there is any risk to these kind of swap lines. But there was that debate in the FOMC, and there's a bigger debate in Congress about that. That's the area that Congress is most critical of, and where Congress was really firing in the summer of 2009, and then again in the summer of 2010 at Chairman Bernanke on this precise issue of the central bank swap. So it's a very, very controversial issue, and I mean, that's probably the prime instance for me of the sense that this is a financial system that's becoming more nationalized and less globalized.
Graham Greene, ex of Foreign Affairs. I wonder, given the bigger role that central bankers are playing and the fact they've come out of the back rooms and are very much in the forefront now, maybe this bridges the economics and politics question again. Do the countries that matter have the appropriate systems for both selecting their central bankers and, if necessary, removing them if they're not up to the task without being seen to be interfering in their independence?
It's an excellent question, because the whole story of the cooperative period, whether it's in the 1920s or in the 1990s and the 2000s, hinges on the idea of central bank independence. But I think it's very important to realize that this is central bank independence in setting monetary policy. And one of the difficulties is that as central banks move into more and more tasks that are not concerned with monetary policy, there will be a demand for closer political supervision. So you find this in the European case, where the ECB is going to take on a lot of regulatory functions, but that needs to be controlled in a very different way to the way that monetary policy needs to be controlled, because regulators, it seems to me, clearly, obviously do distributional politics, and that's why the demand for political control comes in. So, I suspect that this isn't my answer, but this will be the answer in many, many political systems. To your question, to this excellent question, will be to say, no, it's not adequate at the moment. We need more control, and we need more ability to dismiss central bankers that aren't acting in accordance with the mandates that come out of national parliaments. So I think that will be a real issue. And the past in which central bankers said, we fulfill our inflation target and you should reward us for that, that's something that belongs to the past.
Well, I'm just a professor of international relations in a room full of economists, so perhaps my question will, and policymakers too, be a little off the others, but it's a two-part question. If I followed you correctly, the G20 emerged very briefly as a potential clearinghouse and regulator, but that's gone, and we're down to national policies again. So the first part of the question is this: are those national policies, including Dodd-Frank's, all the post-crises policies, are they in place sufficiently, and giving the role of central banks a reformed role, are they there in place sufficiently to prevent another crisis of the kind of global scale that we saw in 2008? And the second part of the question is, it's actually pre-2008, it's what I used to call the Nick Leeson effect. A young man with a computer sits overnight in a bank and bankrupts the Queen's own bank. Is technology a factor in this that might even prevent good policies from being in place to prevent a crisis, once again, of the 2008 variety? What's the role of technology?
On your first question, I think the answer is yes, that this move to more control in a national setting has probably made the financial systems in most industrial countries more secure than they were in 2008, and that's good. The downside of it is that doesn't occur in emerging markets. It doesn't. I mean, that was the first question, the China question, the shadow banking question, hasn't occurred in emerging markets. So there's a great scope for blow-ups there, and it also actually doesn't really allow capital to move in the direction in which capital can be most usefully employed. So. Before 2008, for instance, in the European case, people from the outside looked at Europe and saw capital flowing from Northern Europe to Southern Europe and said, this is actually great. You know, this is how the world should operate, because there's a catch-up potential there. And after 2008, there was a flight to safety, and the capital flight came out of Southern Europe and went to Northern Europe. So this was the kind of perverse movement that often takes place to the United States as well, that the United States sucks in these immense amounts of capital, particularly in moments of anxiety, because the United States looks like a global safe haven. The uncomfortable feeling I have is that the financial systems of industrial countries are probably more robust now than they were 5 years ago. But we haven't overcome the problem of volatility elsewhere, and we haven't overcome the problem of dangers elsewhere. On your point about technology, it's an excellent point. I think that's one area where actually this escalation of tensions and of people thinking in strategic terms, how can you use technology in order to fight financial wars, is really becoming more alive, and we're going to see, I think, more of that as well. That you know, if you're thinking of trying to cripple another country, dismantling its financial system is quite an effective way of doing that. And people will undoubtedly put that into game plans. And so that's another reason for thinking, you know, this is a bit like this early 20th century world that's so unstable. The technology was changing quickly then as well.
Thank you. I've got a couple of related questions, and I know you have a superb knowledge of the European community. I must state up front, I never thought the common currency would work. I never thought it would happen, in fact. And I'm still unconvinced that all countries will remain in the common currency in Europe. So I give you this sort of situation. At one time in the Greek crisis, I mean, we could have had a different party come in, and I think we may have had quite a different outcome. I think this could be something that's foreshadowing an event in the next number of years. Can the European system deal with that effectively, and will they have in place the mechanisms then for that, and what might they be? And the second thing is, perhaps you could just shed some light, it's a different aspect, but what about haircuts for bondholders? Is there going to be a moral hazard there at some point that bondholders, you know, will not want to come up to the plate? Thank you.
On the European question, there was a lot of discussion a couple of years ago about a Greek exit from the common currency, and the fear then was that it would be a kind of contagious exit, that other countries would imitate this, and that the system would unravel very, very quickly. That looks now as if it's extremely unlikely to happen. And even in Greece, I think there are really powerful mechanisms and motives for keeping Greece in the system. You know, it's odd, though, in this debate, how people operate with historical examples, because one of the examples that was being quoted very, very frequently for why a Greek exit or a Spanish exit or an Italian exit would be a desirable thing was to say, look at Argentina. They locked themselves into this really impossible tied-up currency, a dollarized currency, in the 1990s. They exited in a big crisis in the early 2000s. And since then, in this picture that was still being peddled a few years ago, Argentina has done brilliantly, and economic growth has revived, and poverty and injustice has been removed in Argentina. But as we see over the last 2 years, this increasing seriousness of the Argentine problem, I think you can see really the drawbacks of that kind of national solution to the to getting out of a currency board regime. And the Argentine model is now a profoundly unattractive one. It's better and easier actually to do the painful adjustments, and we see those being done in Spain and in Greece. And there's a new government in Italy, and you know, it looks maybe as if there's a kind of reform will in Italy that will break through a political impasse that had been for decades in Italy. So you know, I wouldn't be very eager to think that the European Monetary Union is about to break up. But that then you know, raises really the second half of your question about the bonds. Can very, very indebted governments like Greece really service all their debt? And it's really clear if you do the arithmetic that they can't at the moment. But what's happened over the past years is that this debt, which was substantially held by private bondholders and by banks in the initial phases of the euro crisis, has been more and more taken into the public sector. And so there's an enormous public exposure of Northern European countries to Southern European debt, and a exposure of the International Monetary Fund as well. The International Monetary Fund gets itself into great difficulties on this one because they do the arithmetic very carefully and very wisely and make the argument about the long-term unsustainability of the debt position. But then they say, you know, and that's legally what they're mandated to say, is that IMF debt has to be considered as separate to other kinds of debt and mustn't be involved in haircuts. When people start to chip away at that and to ask for a rescheduling and an interest rate reduction that in effect amounts to a haircut on the IMF debt, that's the moment, I think, when the emerging markets will turn in the IMF and say, this is absolutely outrageous, this is monstrous, this is not what this institution should have done, should be about, and it has the capacity to blow up the IMF. So I think of the hazard problem really existing more for the institutions, the international institutions, than it does for the private sector bondholders who have largely priced this in.
Thank you very much. Well, you brought a great deal of historical insight into these issues. You mentioned my country a couple of times. Well, anyway, I wondered to what extent we have learned from the lessons of history. Well, we suffered very badly from actually it's a lost decade, the lost decade of the 80s in Mexico and most of Latin America. One would think that initially, at the initial stages of the crisis, it was basically an issue of provision of liquidity and monetary policy. But as now sort of the countries in difficulties are no longer emerging countries in Latin or South America, but they're in southern Europe, and there's a new brand of sovereign debt issues. To what extent one learned the lessons in that the issues initially might be issues of liquidity, but I think if you've gone into the long run, you need to do something else which probably goes beyond the power of the central banks and central bank cooperation. You have to go into difficult issues like, you know, structural changes which are beyond central bank cooperation. You have to put in structural changes into the picture. Those countries that made structural changes are no longer having problems. They are now the countries that are so you're having the southern countries in the countries in southern Europe which are not doing any structural changes, and now you're having a new brand of emerging countries which are new countries in difficulties, but they're essentially suffering from the same problems that we initially suffered in the 80s. So one doesn't seem to have learned from the lessons of previous crises. What would you view on this? Your view on this?
No, I think that's a very appropriate verdict, actually. That I mean, this crisis, as the Latin American debt crisis in the 1980s, it really exposes the limits of what central banks can do. What's needed is a mixture of reform, a revised approach to debt management, some of the debt issues might be addressed if you think that there's too much debt. It requires some sort of tax increase, but you don't want to have a tax increase that will reduce the level of economic activity and drive the countries into long-term suboptimal growth states. So, what would be the ideal tax regime? And that I think is part of the situation that's being fought out in the European continent. Is that people in Northern Europe are saying what's needed in countries with high levels of debt and also high levels of household wealth is more of a wealth tax. And you can see ways in which the wealth tax is actually desirable in many ways. If you think of some Mediterranean countries with low property taxes, there are lots of unoccupied properties, and wealth tax would presumably force the owners to sell these things. There would be a market, and you would actually get a new stimulus out of this. So there are lots of good aspects to this, but it's unpopular in the populations concerned, and it's also, it seems to me something that will demand, again, more of a focus on the national setting, that you will want to make sure that capital doesn't move too easily so that it doesn't escape these wealth taxes. So even the solution is pushing in the direction of more national control and more national supervision.
I'd like to go back to your comments on the IMF and Greece and ask you a question about the IMF and the Ukraine, which seems to follow on. In my sense, that is that no one in the G7 will provide any direct financing to the Ukraine or the EU, direct financing in the sense of coming from their own domestic budgets. The EU put up 15 billion, but most of that's from the European Investment Bank and the EBRD, and has a lot of conditions tied to it. We know the Ukrainian government is financially broken, unstable, and so everyone is turning to the IMF. And we know the record of the IMF in Greece, which was to impose completely unlivable austerity measures until they finally realized that dare I use a technical term, the fiscal multipliers were greater than 1, and therefore you needed economic growth to solve a deficit and debt problem. And it'd be nice to sit around the boardroom at the IMF right now, because you mentioned the developing countries, but that board must be split, or I don't know, in any number of ways to not provide support to the Ukraine, right? It's an unstable government. It already has a standby agreement which they're not living up to. So it's hard to lend into a country which is not paying you. So you can see the board managing director reading all the articles to the board about don't do this, don't do that, don't do that, we can't do this, we can't do that. So all this desire to throw the ball into the IMF court strikes me as very worrisome. That unless the IMF comes back and does something that is completely new to them, the Ukraine basically is not going to get the financial support, the 35 billion, whatever that number is, that they are asking for, and that leaves a very untenable situation. So in your mind, looking at the IMF, and if you were in that room, what do you think's happening?
It's fascinating. I think one of the things that's happening is that people are thinking back to bad things that happened with Russia, but particularly with Russia in the 1990s, and that the Russian programs of the fund were very, very political and not well designed, and basically, the worst and the most difficult of them was this one was concluded in July 1998, and just put the resources into Russia in order to allow the elite to get money out of Russia before the devaluation and the default in August of 1998. So there will be one figure that will float around in these discussions as well, and I think it's an important one, is 70 billion is the estimate of the amount of money that was looted by the old government in Ukraine. And obviously some of it was put into the mad palace outside Kiev with the pirate ship and the pheasants and the whatnot. But most of it is undoubtedly not in Ukraine and not in Russia either, but in Switzerland and Liechtenstein and Austria and London, probably not very much in the United States, but mostly in Europe. And recovering a significant amount of that seems to me to be an important task for the international community. So I think you will have to have efforts on this front. Is it Russian money? I mean, it's going to be disguised in various forms. And part of the anxiety of this is also that, yes, it will be interpreted as a financial attack on Russia, and people in Russia will get nervous at this kind of exercise being applied in Ukraine, because you might make exactly the same kind of calculations in Russia. So this is a kind of minefield, but. It would certainly be, I think when you're thinking of the arguments of the emerging markets on the board of the IMF, one of the ones that they would undoubtedly make is this one, that there's been so much money looted that until you make a serious effort to recover some of it, the IMF is certainly not really the appropriate forum for dealing with a bailout.
Yes, well, thank you, Harold. The purpose of the CIGI forums is to provide fresh and informed perspectives into current and pressing policy issues in the world today. And it is indeed refreshing, as John Curtis pointed out, to have a historical perspective on economic policy. From your informed historical awareness, you've reminded us of a period long ago when central bankers could comfortably call each other queer old ducks, but also of times in past crises when responses to economic issues were seen through a security prism, and the lessons that has for us today. So for your insights and your historical perspectives in your essay and your remarks today, we thank you, and also for stimulating an excellent discussion here with our audience, who we also thank for coming. So thank you all very much.
Good afternoon, ladies and gentlemen. My name is Larry Lederman, and I'm the coordinator of the CIGI's Global Policy Forum here in Ottawa. I'm delighted to see friends from the diplomatic corps, especially the Ambassador of Mexico, who is here, His Excellency Francisco Suarez Davila. And we also have members of the embassies of Romania, Slovakia, Italy, Germany, Spain, India, Japan, and Indonesia, and representatives of Parliament, the Department of Foreign Affairs, Trade and Development, the National Defence, Heritage Canada, Finance Canada, the Bank of Canada, and the University of Ottawa and Carleton University. It is now my pleasure to ask Scott Clark, a member of the operating board of CIGI, to introduce our speaker.
First of all, it's a pleasure for me to welcome everyone here this afternoon to CIGI's second forum in 2014. And these forums have shown over the past that they're excellent opportunity to discuss policy perspectives through the eyes of international recognized experts. It is clear that the policy impacts of recent global financial crises will be with us for quite a time, especially as we further our understanding of the interconnectedness of the global economy and its ability to withstand crises. And few people could bring the same level of historical perspective and scholarly depth to these issues as Harold James, our speaker this afternoon. Harold is a CIGI Senior Fellow and a Professor of History and a Professor of International Affairs and a Professor of European Studies at Princeton University, where he's also the Director of the Center for European Politics and Society. So he's obviously a very busy fellow. He's a specialist on German economic history and globalization, and Harold is the author of a number of books, and I think the most recent is The Making of the European Monetary Union, which was published in 2012 by the Harvard University Press. He is a co-author of a history of the Deutsche Bank, which won the Financial Times Global Business Book Award in 1996. He has been awarded a number of other awards. In 2004, Harold was awarded the Helmut Schmidt Prize for Economic History, and in 2005, the Ludwig Erhard Prize for Writing About Economics. His current work is concerned with the history of European Monetary Union, and in the fall of 2013, CIGI published Harold's study of international cooperation and central banks as the inaugural volume in CIGI's Essays on International Finance series. And it is this work that forms the basis for this afternoon's presentation and discussion. So ladies and gentlemen, please join me in welcoming Harold James.
Good afternoon. It's a tremendous pleasure to be here, a great honor to speak about this little essay that was published at the end of last year on international cooperation in central banks in the CIGI series essays on international finance. I wanted in the essay, I think there are copies out there, I wanted to really play with a paradox or a problem, because it seemed to me that in the aftermath of a global financial crisis, whose origins lay clearly in global imbalances and whose transmission mechanisms were very much cross-national, there was prima facie an enormous demand for more substantial and more institutionalized cooperation. But in fact, we haven't really seen that, and we've seen more and more tensions between central banks in terms of their ability to cooperate internationally, and more tensions in the international framework in general. I would suggest, and that's really the bottom line of both my remarks this evening and of the study, that the real problem is that the crisis has produced a change of emphasis. We used to think that the primary responsibility of central banks was monetary stability, a certain level of inflation, low level of inflation. But after the financial crisis, it's become really obvious that at least one of the major tasks of a central bank is the stability of the financial system. And it's that focus on the stability of the financial system that's led central banks to become more nationally focused and, in consequence, less prone and less willing to cooperate. Because if you think of the definition of cooperation, it's a hard topic to define very, very precisely, and there's a narrow line between coordination and cooperation. But both cooperation and coordination seem to me, at least, to imply some circumstances in which a central bank, or for that matter, when governments talk about cooperation, the same story, when they do something that is not in the immediately perceived short-term interest of their particular constituency, for the sake of a greater good, which will have long-term benefits for their constituency, but whose short-term benefits may not be obviously apparent. What's happened since 2008, since the Lehman crisis, in this now 5.5-year period, has really been a general weakening of cooperative processes in general. Two examples that are really not to do with the narrowly defined issue of central bank cooperation. The story of the G20. In the aftermath of the crisis, this was the immediately effective and stunningly, brilliantly coordinated response to the financial crisis. It reached a kind of high point in the G20 summit in London in April 2009, and the then Prime Minister Gordon Brown was boasting about how he'd been able to save the world. And I think a lot of that is actually not exaggeration, but correct, because there really was a threat in the spring of 2009 of a contagious crisis that would have emanated from collapsing economies in Central Europe. The most dangerous one at that time looked as if it was Hungary, and that it required big, effective, coordinated action to increase the resources of the IMF, get IMF programs for the East European countries that were threatened by the collapse then. And it actually effectively stopped the contagion. But even that episode really cast some kind of doubt then about whether the coordination really was such a good idea in the immediate interests of the countries that were doing this. Because one of the points that Gordon Brown, for instance, very much emphasized in the London summit was that the major industrial countries needed a coordinated fiscal response to the financial crisis, that you needed fiscal stimulus, coordinated fiscal